See, you've taken notice of a stock. You believe it's way overvalued. Maybe it's because of a bubble or a mania. Maybe it's because technical investors and momentum have pushed it way above where it should be. Maybe it's just after an overhyped IPO. Maybe it's just a terrible company on its way to bankruptcy. Whatever your reasons, you're interested in shorting it. Yeah, you're really thinking about shorting it. But you've heard shorting is unethical, maybe even illegal. Well, it's not illegal. In fact, it's an important and healthy part of any free market to allow people to take a short position on an equity. I've linked this article from Investopedia in the description. It explains why shorting is not evil. But if you short the standard way, the normal way, selling a stock before buying it back later, it can be dangerous. Shorting a stock this way has unlimited downside. Imagine if you'd shorted GameStop early 2021 when it was around $5, like many hedge funds did. 15 days later, it was at 86. You would have lost a ton, maybe your entire portfolio. Good chance you would have been margin called. If you would have been gutsy enough to short at one of these peaks, then you could have made a lot of money. But that would have taken a lot of nerve and courage. But there is a safer way to take a short position on a stock by using options. You can buy a put. Then you know your maximum loss is only the amount of premium you paid for that put. There are other, more complex ways to take short positions with options, spreads for instance, but those are beyond the scope of this video. We're only going to be talking about buying puts to go short. So you've probably heard these sayings. The market can remain irrational longer than you can remain solvent. And don't time the market, spend time in the market. These are good rules to live by. Shorting is a more difficult long-term strategy. The market has averaged going up 7 to 10% per year over the long run. So you're swimming against the stream. Also, trying to catch the downside time window with options is very hard. Knowing when an overvalued stock finally comes back to reality and falls is not something you can count on. I'm not a financial advisor. This isn't financial advice. This is just educational and informational. Shorting by buying puts is not something I do very often. And if I do decide to go short by buying a put, I size it so I can't get hurt very much. Keep the premium you pay a very small percentage of your portfolio. I'm long 99% of the time, but sometimes the opportunity of a short is just too enticing to pass up. Treat it the same way as any other high-risk investment. Crypto, microcaps, shorting with puts. Keep the size of the investment small. Also, avoid shorting stocks of good companies with good long-term prospects, no matter how overpriced they are. For example, even if you think Nvidia is insanely overvalued, as I do, I wouldn't short it. I typically only buy puts on stocks that have some of these attributes. Questionable long-term prospects with lots of well-financed competition. Bad balance sheets with way too much debt. Negative growth in earnings and revenue. High price to sales ratios relative to its competition. And big discounts in its bonds. For example, if a bond is selling for 50% of its nominal value just a few years from maturity, that's a great indicator that the bond market thinks this company's in big trouble. There's a high chance they won't be paying off their bonds. Let's run through the mechanics of shorting by buying a put. I'll show an example of one of my shorts from a few months ago. But first, if you're enjoying this content and want to learn more about options for long-term investors, please like and subscribe. So when you buy a put, you'll pay a premium for it. You'll be able to choose the strike and expiration. Then you'll have the right of putting 100 shares onto the option seller at the strike price anytime between when you buy it and the expiration. For example, Say stock XYZ is selling for $100. You have a reason to believe it's overvalued and may tank soon. You buy one put at the 95 strike, and you pick an expiration 2 months out in the future, 60 days from now. You pay $5 for it, that's $500. Recall that each option contract controls 100 shares. So what kind of things could happen after you buy it? The value of that put option is going to fluctuate between when you bought it now and when it expires 2 months from now. If XYZ stays above your strike price, like the top red line, its value will slowly decay over the 2 months and eventually be worthless at expiration. So you'll lose your entire premium that you paid for it. If this red line had dipped slightly below the strike, say to 94, then your option would have been worth $1 or $100, and you would have ended up losing $400 because you paid $500 for it initially, and now it's only worth $100. Your break even is going to be $90 because you paid $5, the strike is 95, so it's got to get at least $5 below the strike for you to break even. The green line shows what you want to happen. XYZ stock falls all the way down to 87 at expiration. So you'll show a $300 profit if you hold it all the way to expiration. You paid $500 for it, and at expiration it's worth 95 minus 87 or $800. So 800 minus the 500 is 300. That's your profit at expiration. You don't have to hold them to expiration. You can sell to close at any time between when you buy it and expiration. Or you can execute it at any time. Put the 100 shares onto the buyer for the strike price. But it's almost always better to sell to close instead of executing, because if you execute it, you'll be forfeiting any remaining time value the option has. The put option will show up in your portfolio as a positive number indicating its current value. And again, you can sell it or execute it at any time. One stock I've been watching and have been short before is Carvana. I'm considering shorting it again. I'm not advising you short it. This is just an example of some things to look for if you're inclined to go short on a stock. Here's the timeline of my previous Carvana short. It happened from January through March of 2023. I bought the put right at the end of January, just above the strike price. I set the strike at 10. At first, I was losing money. Carvana continued to go up, but then it started falling again. Towards the end of February, it had fallen enough where I decided to close it out and take a small profit. It turned out to be a good decision because if I would have let it go all the way to expiration, I would have made $2.50 because it closed around $7.50. Where I closed it out here when it was around 8, but then with the additional time value, it ended up being more than if I'd closed it out when it expired. So I bought 4 puts for $275 each, and it cost me $1,100. And then a month later, I sold those 4 puts for $290, which worked out to be $11.57. So I made a whopping $55 profit. This is one reason why shorting is so tough. The stock did what I thought, just not fast enough. So I just made a tiny profit. Making money shorting a stock like Carvana is challenging because first, the volatility is very high, so the put premiums are really expensive. They're inflated. Second, the market isn't stupid. It knows Carvana has some serious problems, so the put premiums are further inflated. But ideally, you'll buy a put just before a big drop in a stock, but you have to be good and lucky. Let's take a quick look at some Carvana financials. So its market cap is $2.73 billion, but its enterprise value is $11 billion. So right off the bat, you can tell it's got huge debt. anytime the enterprise value is way above the market cap, that's an indication that it's got a whole lot of debt. Its price to sales is pretty cheap. It's only 0.23, but rightly so, since it's got high risk of bankruptcy probably. It's got negative revenue growth year over year. It's got 800 million in cash and 9 billion in debt. So its book value per share is -6. That's not good. And then in the trailing 12 months, it made a lever-free cash flow of negative 336 million. So it's probably going to need more debt unless it really turns things around quickly. It's going to have to find some new financing. So let's take a look at its income statement stuff, revenue and earnings. I like to look at this chart over here. So up until recently, it had nice revenue growth, but then it really started losing money in 2022. It lost 1.6 billion. And if you drill into quarterly, you'll see the revenue growth has totally turned around. Lost 800 million in just the last quarter. Now I've heard things are getting a little bit better for it, but its business plan is in question, to say the least. Here's a chart of Carvana over the last 5 years. Imagine if you bought a Leap put back when it was over 300 bucks, right around here. I wasn't smart enough to do that, but anyone who did made about 300 times 100 or $30,000 per contract, because they pretty much realized all of that. Linked in the description is a recent article from Seeking Alpha written June 20th, 2023. I cherry-picked a few of its points. Despite the rosy picture in Carvana's latest press release, Carvana has never made money in its 8-year existence. The business is shrinking, not growing. It currently does not generate enough cash to pay the interest on its massive debt. Total debt exceeds 8 billion and shareholders' equity is negative. Carvana's bonds trade at a big discount to their nominal value. For example, the 2028 notes traded around 50 cents on the dollar. The 2030 bonds have a 36% yield, indicating that bondholders see a risk of bankruptcy. 500 million of bonds come due in 2025. It's unlikely they can generate enough cash to redeem those bonds. So they'll need to find alternative financing or go out of business. So those are the kinds of things I look for after identifying a stock I think is overvalued. I like to give myself a few months or even longer to be right, and you don't have to hold to maturity. If it takes a fall shortly after you buy it, feel free to close out early and make a nice profit. In conclusion, it's okay to short. In fact, it's fun and can be profitable, but it's harder than going long. The market goes up in the long run, so you'll need to be very skilled and very lucky at finding the right stocks to short at the right time. If you do decide to short, it's less risky to use options rather than selling a stock short, because you can precisely define your downside. Please consider liking and subscribing if you enjoyed this content.